Hello, everyone, and welcome back to another episode. My name is Jordan, the Millennial Investor, and today we're giving a monthly update on my portfolio. And I have to say, complete opposite from last month. This has been a huge turnaround because now we are outperforming the S&P 500 and all the major indexes outside of the Nasdaq. And you can see our portfolio balance has skyrocketed as of late up to almost $60,000. Now, here's my performance shown live on my portfolio as of December 1st, right after you guys are seeing this. And essentially, we have had a huge comeback, mostly just within the last month or so. November was a really big month for me, and the good news is we're starting to come back in a big way. Now, I'm going to show you my portfolio. Here's every position I currently have open as of December 1st, and here's everything that I'm planning on holding throughout the next month, throughout the next year, whatever. And I'm going to go over each major position with you. Now, a bunch of these are a bunch of sold options, so many of these will change or be closed out by the time you see this, but the main positions that we're going to talk about, the big ones that I'm holding on to, and I'll tell you my intended holding period for all of them, is these 5 that you see right here, which in order from smallest to largest, we have 7.5%, which is actually a short play, which is on Sunrun, the solar company. Next, we have Celsius, the brand new holding, which makes up 12% of my portfolio. Next, we have PayPal, the one that I've been holding for a few months now. Dropbox, the position I've had for about a year plus now. And then Crocs, also one that I've held for about a year, making up the largest position at 36.8%. Now, this is great. Oh, I need to update this from 9/1, updated as of, wow, that's super outdated, as of 12/1, so I need to update that. But anyways, here's my portfolio, and here's what I'm planning on doing. I'm going to go through each holding with you, and I'm going to talk about the pros and cons to all of these, and I'm going to go ahead and start from the smallest position and work up to the largest. So without further ado, thank you for joining in. Thank you for tuning in. Check out all the stuff down below in the description if you haven't already, and let's go ahead and get started with the smallest position, which is Sunrun. This company has seen a dramatic slowdown in revenue growth. From a company that was once booming in revenue growth, going from 2020 revenue levels of about 200 million every single quarter, reaching all the way up to 600 million plus just 2 years later. Now, ever since this quarter, let's zoom into the last 3 years. Let's get an idea. Ever since this peak back in about a year ago, third quarter of 2022, we've seen 631, down to 609, 589, 590, and now down to 563. Now, the main thing for me is not the revenue growth. While I think they will struggle with revenue growth due to rising interest rates, the main thing for me is this free cash flow. This free cash flow has gotten worse and worse and worse, and this company has no way really of making any type of profit from what I can tell. Their gross margins are on a downtrend. They are breaching gross margin levels of around 8%. It is getting worse and worse for them by the day. Their operating margins are disgusting, far into the negative, normally averaging around 30-35% in the negative. Same thing for profit margins, not looking good. Essentially, this is what I consider to be a bad company. And instantly, no matter what the company is, now this isn't a end-all be-all, this isn't one rule that you can apply to everything, but generally speaking, if you see a balance sheet that looks like this, look at this debt pile increasing over time. This is not an annual chart. This is quarterly. This is every 3 months. Now go ahead and pause the screen on any of these if you need to add them up, but generally speaking, average level, they're probably adding roughly 400 million, 500 million of debt every single quarter ever since this 2020 period. They took their debt back to the beginning of 2020. Let's actually do this. Let's go to the end of 2019 and let's go 4 years ago. This company had 2.2 billion in debt. Fast forward today, that 2.2 billion in debt has grown to almost 10 billion, almost 5x. This company is raising debt big time while their cash pile, let's look at their cash, has stayed relatively flat, just about 500 or 600 million every single quarter. Now, this company is getting more and more indebted, and this company's interest expense is going through the roof. And I think, unless this company can have dramatic sales increases, unless they can lower their costs significantly and get profitable, which keep in mind they're nowhere near doing. So let's look at this, for example. This company produced 563 million in revenue, but their free cash flow was negative 804. Their free cash flow number was larger in the negative than their revenue was in the positive. So this company not only needs to reduce costs and become profitable, they need to massively shift their business model to something that is more sustainable, because right now, if this stays anywhere near this level, even if they were, and honestly, in my opinion, if they could reduce these losses by half, if they could only lose 400 million each and every quarter, I think this company would still be leading to bankruptcy. And that's why this company, ever since the 2020 boom, if you look at the 10-year chart, you saw this company go up big during 2020 and 2021. And ever since then, it's been a slow bleed out. They reached basically $100 a share plus up here, and then they have downtrended and downtrended and downtrended, and now they're back into the teens. Way back to their pre-COVID levels back here at $5, $6. I think that's where they're going, if not more so. They could even up going to zero if they do not get this debt under control. So the way I look at it for me is that this company is a hedge against the market. If the market goes down, I think that this will obviously go down with it. But honestly, regardless, if the market rips higher, while this company could go a little bit higher as it recovers from rising interest rates, or I should say lower interest rates as it starts to get more attractive for solar companies, I think that this company has a long way to go to get to any level that's sustainable. Even if the stock price went to $40 tomorrow, the only way that this company can stay alive is by either raising more debt or selling shares on the open market, which is obviously not good for shareholders. Going back to my positions page here, we're going to the next biggest position of the portfolio, and looking at my chart, the next up in line is Celsius. Now, I did just make a Celsius video the other day, so I don't want to make this too in-depth, but essentially with Celsius, the main bullish point for me is that when I look at the roadmap that Monster went on, actually, let's go ahead and put up Monster first. This company had a massive uproar in revenue over a 2-decade period. This company is on a huge upswing, going back to around 2004, 2005, when they rebranded their company, and then back during the financial crisis when they got their big partnership with Coca-Cola. This company has just been up into the races, as consistent as you could ask for, especially for a consumer company. Now, this company has not only reached revenue growth, but they've reached massive scale and profitability, now producing hundreds of millions of cash flow a quarter. And as you can guess, their profitability has led to massive share price outperformance. 10 years ago, this company was around $10 a share. Today, they trade around $50. They 5x'd over the last 10 years. If you look at the all-time chart for this company, it's absolutely ridiculous. It's disgusting. Now, I will say that this company, Celsius, will likely not have that percentage of outperformance based on where we're at today, because the company has already reached a valuation of roughly $12 billion, 12.04 as of today. But if you look at the last 10 years, this company has continued to go up, and I think that the track record for Monster will be very similar for Celsius, because if you look at its revenue growth, it's actually been more impressive than Monster comparable to its early stage days. Now, this company has went from 2020 doing around 30-40 million in revenue to in the most recent quarters doing almost 400 million in revenue. I think that this company will scale big time. This company hasn't even started its international reach yet. Canada is starting next month, January 1st of 2024. They're starting that next quarter, and they haven't even reached other parts of the world yet, like Africa and Europe and Australia and all these different regions that are so important to this business. And I think even though this company is a baby stage now, if you look at the more recent quarters, let's zoom into the last couple quarters here, you see that this company is already producing positive free cash flow. So I see a perfect setup here where this company, thanks to its Pepsi deal, once again, let's zoom into the last couple years, you see this huge influx of cash here right around September of 2022. This company had its Pepsi deal go through, and they have 500 plus million. In the most recent quarter, they now have almost 800 million of cash on the balance sheet with, you guessed it, zero debt. Normally, this is where I filter out this chart to add debt. They don't have any, so this is the only chart we have here. This company has no obligations in terms of long-term debt, but they have $760 million of cash on the balance sheet. Furthermore, even if they didn't have any money on the balance sheet, they can already supplement their own business because they're producing positive free cash flow. So I think the revenue growth story is going to continue to be massive. This company will already produce profits at today's level. But considering that the company has almost $1 billion to reinvest back into itself, they're already producing positive quarters, I think that we will see lots and lots and lots of expansion. And one day, over the next 3, 5, 7 years, you'll start to see huge share buybacks and or dividends. Either way, it's going to be return capital to shareholders, but as this company grows, I think the share price will go with it. You'll see that Monster is roughly 5 times the size of Celsius, because if you look at Celsius right now, they're doing around 400 million roughly in revenue each quarter. And if you look at Monster, what they're doing each quarter, they're doing roughly 1.8 billion, about 2 billion or so. So this company needs to 5x in revenue to go up roughly 5 times in price, almost exactly where this company is trading at now. And I think that Celsius can get to that point. So Celsius is one that I'm holding, likely going to be a long-term hold for me. I'll continue to generate option income as we go, but I'm really excited about it. Next, if we go back to my little holdings chart here, you can see it next in line is PayPal. Now, I pulled up a couple slides here for PayPal, and I'm going to talk about these briefly. And we've had a massive change in the business. Normally, there's lots of small updates, a quarterly report, some updated charts, maybe a little piece of news that maybe they're selling off a piece of the business or doing this, doing that. But with PayPal, we have a massive thing to look at. Now, the first thing I want to talk about is the free cash flow. The free cash flow is changing big time. Now, if you look at this number that I'm highlighting right here, this negative number of 350, it's actually not really accurate. It was due to a one-time write-off. Because if you look at this, they have an adjustment for HFS, which is held for sale impact, due to them selling off a piece of their business. So actually, if it wasn't for this one-time cost, they would have had 1.2 billion more in free cash flow than they showed. So they actually would have put about 0.9 billion in free cash flow, which if you look at this number, is pretty much right in line with what you see from their previous quarters right here. Pretty much flat. Now, not outstanding, but it doesn't look nearly as bad when you consider that this is a negative number and it was pretty much just flat quarter over quarter. Now, let's look at the next number. Once again, pretty much flat around 1.1 billion. But hold on here. We have, coincidentally, another one-time adjustment quarter over quarter for this company's free cash flow. They had another adjustment for HFS impact of 0.8 billion, and that means that if this wasn't a one-time cost, once again, one time, not recurring, this will not show up next year or the year after that. If this was not a one-time adjustment, the free cash flow actually would have been around 1.9 billion. Now, if you look at this chart and you look over the last several years, 1.9 billion is pretty much the highest they've ever seen. Outside of this one quarter back in 2020 when we first had shutdowns, outside of that one freakish quarter, 1.9 billion is the highest this company's ever seen. You see highs here of 1.54, 1.55, 1.77, but no 1.9 billions here. So this company actually is pretty much reaching all-time highs on a quarterly basis in terms of its free cash flow if you exclude the freakish COVID quarter when they first shut things down. So this is really exciting here. Looking at this company starting to reach new all-time highs in terms of free cash flow, I think is partially going to come from the change in the business model from our new CEO, Alex Chris. Now, obviously, this is 14 pages long. We are not about to go through and read all 14 pages of this earnings call. Now, what I highly recommend you do, if you are interested in buying PayPal, or if you're already a PayPal shareholder, this is not really an option. I think you have to read this earnings report. I will say sometimes companies have earnings report that are really important, sometimes not so much. Sometimes they're really boring and they don't really give you a lot and they just go over their numbers that they already produced and then they pretty much close out the call, maybe answer a question or two, and that's pretty much it. I will say in this call, this is Alex Chris's first conference call that this company has had in terms of a quarterly basis, and I think he outlines the new business model very well. He talks about the new goals that they're going to do. They're going to focus back on their core business. They're selling off some parts of their business like shipping returns and stuff like that, and their buy now pay later segment in the foreign parts of the world. But anyways, they're going to talk about new business metrics. They're talking about all types of good stuff that I think is helpful for a PayPal shareholder. And essentially, if you haven't already, I would highly recommend that you check out this earnings report because it will give you lots of insight to what this is going to look like moving forward. Now that said, PayPal is one that I'm holding right now. I do have this company at an average share price at around $63 a share, and it's currently 59.65. So this is one of the only major holdings right now that I'm down on that I've been holding for a while because I initially started my position back in June. Now that's not very long. That's only 6 months, but still it would be nice to be in the green on this company because I pretty much built out my position. I wouldn't sell this company until we started to get to at least, I would probably start to trim as we start to get, the 70s, the 80s, but I'd really like to exit fully around $100 plus in this position. But next up, we have Dropbox, and I won't talk too thoroughly about Dropbox because I've been holding this company. When did I initially buy my shares? My oldest shares that I'm holding were back in February of this year, so I've been holding this company for around 10 months or so now. And Dropbox is one that's as consistent gets, one that people overlook in the market because it's very boring. Now, while this company may be boring, they are as consistent gets because look at this quarter over quarter revenue continually growing in a bigger and bigger way, and their free cash flow is doing a similar thing as well. Consistently growing free cash flow, hitting a new record last quarter of $246.5 million, and this company is reducing its shares huge as this company continues to buy out more and more shares. They are reducing the amount of ownership of other public shareholders, and I get my ownership increase of this company each and every quarter. Just in the last year, they bought back roughly 4% of the company's shares outstanding, and this company has a healthy balance sheet as they are net leveraged of zero, as they have $1.3 billion in cash, $1.2 billion in debt, and it's just one that's consistent as ever. Now, I will say that this company has started to outperform. If you look, this is one that is one of the best performers on here. I have already taken a lot of profits. I did originally have, I think, 1,500 shares. I'm down to 700, and this company is up roughly 40% of my average share price of around $20, and it's reaching almost 30 now. 30 plus is where I consider selling completely out, and you can see that we're starting to near that. If you look at the last 1 year, you can see that we were flirting with this $26, $27 range, and now we're up to the 28 plus. We're almost reaching $29, so this is getting close to where I would sell out. Now, I do have some other positions that I'm looking at possibly building out, and now that the market has recovered quite nicely, I want to move to a more conservative state where I'm reducing all or at least most of my margin, so don't be surprised if we reach 30 plus if I start to sell all or at least most of this Dropbox position. It's been a good runner for me. It's been a good holder to receive 40% plus returns in less than a year, and basically a year span is phenomenal. I cannot complain about that at all, and that's not even including on top of the options income that I've been receiving every single week, every single month while holding it. So Dropbox has been a good one for me. Spending $14,000 to return over $20,000 has been a great one. And next up, we have Crocs. I've reduced my Crocs position slightly from 400 shares to 300 shares, and it's one that I think is overall doing a lot better than people mention. Which, by the way, if you want to pause the video, this is the financial highlights of the third quarter of Dropbox earnings. I forgot to show that, so pause the video if you're interested. But moving into Crocs. Crocs is one that has grown huge overseas and kind of stagnated here in America. And they've had a rough segment from their penetration for their Hey Dude segment. It's been a story all year where Crocs has been growing just fine internationally. I should say great internationally, okay in the US, but the Hey Dude brand has not performed the way I thought it would. Now if you look at their growth compared year over year, you'll see that their growth is mainly coming from overseas, specifically in the Asia Pacific region. I've heard some segments of China of growing almost almost triple digits for some regions of China for Crocs products. Now, if you look at their quarter four estimates, they're projecting 4 to 7% revenue growth for Crocs and negative 25 to 20% revenue growth for Hey Dudes. Now, what I want to show you is Google Trends for this company on Hey Dude. If you look at 2022 compared to 2023, and also if this is easier for you, I'll also show you the 5-year chart as well, just so you can get an idea. You can see at this company, while it is seeing a bit of a downturn, especially during this region of October, November has started to pick up quite a bit compared to last year. If you look at this zoomed in once again over the last 2 years, you see that they're reaching pretty much the same levels of last year. Now, I see that it is a bit of a downtrend here in October, but they're starting to pick up some. So while I don't think they're going to have any massive revenue growth number, the projections for Hey Dude are just to the floor. Negative 20-25% revenue growth is disgustingly bad. That is so terrible. I think they will do better than this. While do I think it will be a negative number? Sure. I think it probably won't be the best, but negative 20-25%, I think they will beat that. And the good news is I kind of see a similar story here for Crocs. If you look at their year-over-year chart, and I'll also pull up the 5-year charts for these as well, just so you can get a bigger zoomed out picture, you can see that they're pretty much doing as good as ever. These are the United States numbers, and they're pretty much reaching highs compared to last year, beating out Black Friday searches. And if you look zoomed in, you can see the same thing. Now, if you look at this on a worldwide basis, you see a similar story. If you look at this on a 5-year chart, it becomes more apparent that they're reaching highs this year in 2023, far higher than they were in 2022. And on a zoomed in factor, this is what this looked like. So I think that this 4 to 7% revenue growth, I think that they could beat that. So honestly, while I don't think that this company is going to produce, a 20% revenue growth or anything crazy this quarter, to project a negative number, 4 to 1%, I think that this company could probably produce a very small positive number, maybe positive 1 to 3% revenue growth. Regardless, I think that this company is becoming a lot more profitable, and that's really what gets me excited as a shareholder, because if you look at their recent quarters of profitability, you're reaching much higher levels than you've seen in any other years, including that of pre-COVID. Because in the last couple of quarters of 2022, you were seeing an average, 136, 129 of profitability. And in the last 2 quarters comparing that to this year, we've seen almost 300 and 215. The first 3 quarters of 2022 produced, roughly speaking, around 150, if I'm adding these numbers up correctly, around 150 or so of free cash flow. Now, if you look at this year, they produced roughly 500 million. They've doubled their free cash flow this year, and I'm excited to see how quarter four pans out. So this one is still super cheap, considering they're going to produce 6 to 700 million of free cash flow this year, and this is only a $6.4 billion company. While we've started to see a bit of a revival in the stock price as of late, I think that even $100 is still far too cheap, and I probably wouldn't start to look at selling out of my position entirely until we started to get to, the 120s, 130s, 140s, depending on where my position is at in the portfolio. And meanwhile, it still is my largest position. It still is about a break-even level for me. I'm slightly up, but nonetheless, it's one I plan on holding as of today's prices. Other than that, guys, thank you all so much for watching. Check out the stuff down below in the description for mentoring or referrals or whatever you're needing. But other than that, thank you all for watching, and I'll catch you all next time.